introduce. Okay. Hi everyone, this is Finance Meets Real Estate. We have a great guest here today. It's a pleasure to have him. It's Ken G. So Ken is the president and founder of KRI Group of Companies. He will discuss with us how to consistently make money in real estate. So throughout his career, he has been involved in transactions valued in excess of $2 billion across real estate, banking, and private equity. His company is a vertically integrated real estate investment and management company. And his KRI Properties, which is a multifamily property management for assets owned by KRI. So KRI Partners is a real estate syndication company specializing in the acquisition of multifamily apartment communities in the central and southeast United States. So Ken has over 24 years of experience. He'll share, I'm sure, like some of it with us today. So I'm really excited to hear what he has to say. So we are doing a more conversational format today. So feel free to put your questions either on the chat if you're feeling shy, or speak up and ask your questions. So there will be a YouTube recording as well in the event anyone needs to drop out from the call. So with that, I'm going to pass it on to Ken.
Great. Thank you, sir. I appreciate the introduction. And thanks so much for having me. I really appreciate it. I'm really impressed with the number of people that are here. No doubt, lots of interested folks. So thank you for that. As he said, I do want you to do me one favor. And what I don't want to do here is spend a half hour, 45 minutes just talking at you, right? I'd really like to make this as conversational as possible. I chose the topic that I chose because I think it's really important, especially right now, that real estate prices are continuing to get higher, and we as investors, sponsors, fund managers, whatever it is that you are, we really need to be super careful when we underwrite our deals and make sure that we're nailing it. So please, I'll try to watch the chat window and stuff, and if you would do the same as well, please, because I tend to get carried away with.
Absolutely, yeah. I would relate anything on the chat, Ken. Don't worry about that.
Fantastic, thank you. So what I wanted to talk about today was the title of the presentation is How to Consistently Make Money in Real Estate. Anybody can do it just once, right? If you happen to have bought into a growing market and you happen to have been to a nice neighborhood, and as you're learning, I've over many years, I've had folks come into the business with one, maybe two successes, and then they start to get nervous because things start to get tighter, they start to get tougher. So that's what I wanted to talk about here today. And there's really four things that I want to focus on. And that is things that you should be looking at. And I'll take you through the process here. The first thing I want to talk about is just some discussion on supply and demand. And it's really important. You got to start there. Secondly, I want to talk a little bit about leverage and how to use it. Third, I want to talk about cap rates and how I use them, and how I am very careful about using them to make sure my terminal cap rates try to keep me out of trouble, especially as we find ourselves in a rising interest rate environment right now. And again, finally, we'll wrap that up with I'll try to tie this all together with a value creation discussion. So, as I think about what we're finding ourselves in right now, I don't know if you've thought much about the overall economic environment, but we clearly have inflation here. It's just around the corner, and in many cases it's here, and it's going to be here for at least a little while. There's no question about that. There's a lot of volatility in different markets, and in non-investment real estate, the volatility is actually driving people into our asset class because they're just getting so tired or nervous with all the volatility. So I don't know if you're seeing it in your markets, but I certainly am seeing it in ours. Let's see here. There is no doubt that with some of the stock market prices, that there is becoming more and more a disconnect between the value of an asset and its ability to generate cash flow. And I'll talk about this a little bit, but one of the things that I really love about what we do is the fact that the ability for this asset to generate cash flow is fairly predictable. And that's really important because I feel like we're in an environment where this disconnect really makes that difficult to predict going forward. So let's talk about, let me start with supply and demand, because when we look at markets, when we look at where to invest, I literally start from the macro and work my way down. And it always starts, if you haven't had an economics class in college, this business starts always with supply and demand. So we focus in Florida. Let me talk a little bit about Florida, and I'll use that as an example. And then I'll contrast that with another market that we're in or have been in that is sort of the opposite. So in the Florida market, or in Texas, or in Arizona, or most of the Southeast and Southwest, basically the Sun Belt states, we find ourselves in a situation where there's increasing demand. So in Florida, there's about 1,000 people that move into the state every year, and that's net in migration. So that means net of deaths, net of people moving out. That's a pretty hefty number. I don't know what the number is for Texas. Somebody on this Zoom probably knows. I just don't know what that number is. But in the Florida world, let's assume for a minute that about a quarter of those people are wealthy and about 3/4 of them are not. And there's a reason that matters to me. So the first thing we look at is population growth. What we always find is population growth follows employment growth, right? People don't move to an area where they can't get a job. So generally speaking, employment growth is always there right alongside of the population growth. So clearly an increasing demand, more people moving into the area. If we're, I think we're all talking about multifamily here, that's critical to the long-term success of the asset. Now let's look at the demand or the supply side, because that is also the key, right? Demand and supply has two sides to it. When I look at, we do BC class assets. So let me look at the various classes and analyze supply in those classes. Most people say to me, Ken, why on earth would you want to go to Florida? They're building so many buildings there and so many apartments. Why does that not worry you? And my response is always the same, and that is, builders are building in Florida, but they're building A class assets. They're not building B and C class assets. Now, I would venture to guess similar is true. I haven't studied Texas. I haven't studied some of the other Southeastern markets yet, but that generally is the case. Builders, especially with the cost of lumber right now, they can't afford to build that BC class stuff. So we have increasing supply meeting that increasing demand on the A class stuff, right? I said about it, maybe a quarter of those people are wealthy and can afford $3,000, $4,000, $5,000 a month in rent. But most of the people that are moving into states like Florida, they're just normal people. And they're looking for a nice place to live that is not going to break the bank. That's a BC class asset. That's what we like. We like it because there's currently no increase to the supply side. So we find ourselves in a situation where we have stable supply, increasing demand. Well, if you think back to your econ days, that's exactly how you define a bull market, right? Increasing demand is going to pull the price of that market up. So of rents, let me say. So now let's take that and think about what type of strategy you're going to use when you buy real estate. So all you need is the demand supply curve to be in your favor if you're a long-term holder of real estate, right? Prices are just going to automatically go up because the increase, the demand will drag those prices up. Some people call this a rising tide lifts all boats. It's happening everywhere, right? So you can be a long-term holder, a buy and hold, a 10 or 12-year holder, and do just fine and probably do quite well as long as you're patient. However, most people aren't patient, so including our investors. So we tend to do value add deals. The reason we do that, when you take this bull market and you put on top of it a value add business plan where we're purposely increasing the cash flow of the asset, now you've got crazy returns, right? You were getting pretty good returns just from the normal increase in pricing. But as soon as you put a value add strategy on top of it, you can get 15, 20, 30% plus annual returns without even having a long hold period, right? That's generally what we tend to focus on because we like those big hits. Our investors like those big hits. There's plenty of patient investors out there, but right now, most of our investor base looks for those types of things. So when I look at the overall market, I look for this demand supply relationship to stand. Now, when we do this, and now this is the part that frustrates a lot of people. We also do third-party management. So I get the opportunity to talk to a lot of people just like you who are investing into a market and they need a third-party manager. So I get that benefit. And one of the frustrations that people have in markets like Florida is that over time,
Stop and start your video.
oh, sorry, that over that over time, these, oh, let me back up. It frustrates people because when they dive into these markets, they get the macroeconomic picture, but when you look at the microeconomic picture, that's the next step. And that's the step that most people don't think about or really hyper focus on. So when I look at population growth, employment growth, we look at it in my number one stat is a 1 mile radius, a 3 mile radius of the property I'm looking at. And I try to analyze the demand and supply situation for that little submarket, because we know most people that are looking to rent an apartment, they know roughly where they want to live, and they start driving around and they look for properties in those areas because they've defined a neighborhood that they like. So we want to make sure that they're liking those small neighborhoods and there is growth in those submarkets. I call it submarket. It's actually a micro submarket when you get down to that level. So I want to make sure the message that I want to send here is make sure that you focus on that demand and supply curve, even at the micro market level, because it is critical.
And if I may interject, so on that, like that's a very good point that you're making on the like the micro market, so to say, or like micro submarket, let's say. But what are your data sources for that? Because if you take like census, okay, you have population and housing supply at the state level, you have it at the county level, but it pretty much ends there. So
yeah, good question. So we have used CoStar. We have used Real Market. It has a product out called Market Analytics. RealPage does, and we now currently use Yardi Matrix. So I don't those services. I don't think Market Analytics does not do a good job with the demographic stuff, but CoStar is not too bad. Yardi Matrix is very good at it, and so I'm not looking at county level. For example, think about Jacksonville, right? I don't know if you know much about Jacksonville. But one of the unique things about Jacksonville is almost the entire county of Duval. Well, I mean, there's a really, really big difference between south part of Jacksonville, north part of Jacksonville, so on and so forth. So we don't even look at it at the county level. When I say I go down to the 1 mile radius, 3 mile radius, I do that and I spend a lot of time on that. Let me give you an example. Let's say you're looking at a property. It's located at 123 Main Street, right? And you use your Yardi Matrix and you pull up the property report for that apartment complex. When I run demographics at 1 mile, I pay attention to a lot of things: population growth, employment growth. I'll also look at median income for that area. And so a lot of people don't connect these, but they're really important. If you've got median income of, say, let me pick some round numbers here. Let's say it's 24,000. I'm going to be extreme with my example just for illustrative purposes. But let's say your median income is 24,000. That means these people are making 2,000 a month. Well, if your management philosophy is that you want your renter to make 2.5 to 3 times rent, you've really put yourself into a small rent situation. Most people are not going to pay more than what's a third of 2,000. We'll call it 600. Okay. For round numbers, we'll say $600 or $700 a month. That's about where your rents are going to max out, as compared to another 1 mile radius or a 3 mile radius that has 40, 50, 60,000 median income. Now, I believe once you get over a certain point, people that make median income areas that are 100,000, 150,000 a month or a year, that's not a relevant stat for you, because unless you own an A property, those people probably aren't renting BC class property. So it only matters up to a point. But what I want you to do is know what that median income is for that market, do the math, divide it by 12, divide it by 3, and say, okay, is there enough income in this submarket to get the rents that I think I want to get after I do my renovation on a particular property? Does that make sense, Stephen? And actually, all this information is available on the through the U.S. Census Bureau. It's just not pretty. I mean, you've really got to be a data geek to go ahead and get through it. That's why I prefer to use something like Yardi Matrix. Let them summarize it and make it look good for me so that I can use it without spending a ton of time analyzing it. So, excellent question. So, we talked about demand supply. We talked about macro, we talked about micro. Those things are important because we want to try to identify a bull market. Let me contrast that to some of the markets like, think about the markets, well, New York for a while during the pandemic was the exact opposite, right? That's why rents went down, right? People were leaving New York. And I think that's starting to stabilize and change now. But for the longest, for at least well over a year, we have people leaving New York. Cleveland is another example, right? Some of you may have invested in Cleveland. I happen to be in Cleveland at the moment. This company started in Cleveland, so I know Cleveland's demographics pretty well. And when we have a situation like Cleveland, where we have demand that is actually slightly declining, we don't have anybody building any BC assets still because they still can't afford to, it actually creates downward pressure on rents. So in order to make money in a market like Cleveland, your going in price has got to be really carefully modeled because you're not going to get that rising tide lifts all boats concept that you get in a growth market like Florida. So in a market like Cleveland, you've got to make sure that you know how you're going to create the value, because the money that you make is going to be 100% the value that you created. You're not going to get any of it from the overall economy or the overall growth market, because it's just right now, it's just not like that. Hopefully that'll change. I know they're looking at new leadership in the city of Cleveland, so hopefully that'll change. Go ahead.
One question. You gave the example of New York. So yes, I mean, I think anecdotally, we all read that, okay, people are leaving New York, but that's not something that one would capture in census, right? It's too far and, too stale to really show those kind of trends. So, and that also, even if it shows, it'll probably show it for the whole city. So then how do you get it for the micro market on a more, if not real time, but like a more frequent basis?
Yeah, that's a really good question. You're right. The 1,000 people a day is probably pre-pandemic numbers that I'm citing you, because there is a lag. You're right. And that comes, so what I do, if I'm going to a market I don't know, I literally get on Google and I start searching for what's going on in that market. I'm looking for employers moving into that market. I'm looking for stories in the maybe New York Times or whatever the local news sources are. I'm looking for stories about people leaving. I'm talking to the apartment associations. I'm on the ground. Well, most brokers are going to tell you their markets are growing no matter what. So you got to be careful with that. But when there are signs that will tell you that the market is a weak market. For example, I think they were giving, the concessions in New York went up pretty quickly. The vacancies went up pretty quickly. So that tells, that is a much quicker way to see it. Now, I personally think long-term people in New York are going to be fine, because it's going to be hard to displace New York as the financial capital. It just is. So it'll take some time for it to come back, but I think it will come back just fine. This is really more of a pandemic related issue. The other thing that I want you to watch out for is the diversity of the growth in a market. When I say diversity, I'm not talking about race or anything else. What I'm talking about is employment diversity. For example, I'm not a fan at all of locating a property or buying a property near a military installation, right? There are guys and gals that make a ton of money doing that. I don't like the risk, because if Congress decides to close a base, I'm out of business, right? And I don't like to be that dependent on one particular employer. Same thing happens with people who locate their properties next to the amusement parks. Sound familiar? In the pandemic, those properties that were located in tougher neighborhoods right near the amusement parks of Disney and all the others, and all the hospitality that was around it, Universal Studios, sorry, couldn't think of it. They had a similar problem because they were so focused on one industry. When the hospitality industry got killed, so did their properties. Now those properties are back now and they're fine because everything is moved back, open back up. But excellent question. Is you just got to know your markets and pay attention to any indicators that you can. And I always tell people these little markets have sort of personalities, and you can kind of feel it if you spend some time on the ground there. And that is something else that I would encourage you to do. Good question. Anyone else? All right, so I beat supply and demand to death. Just start there, please. Okay, so that you know what kind of market you're in and you know what kind of headwind or tailwind you're going to get as you're trying to implement your plan. So now let's talk about a little bit about leverage. And my comments with leverage are going to really kind of drive into my cap rate discussion, but I want to make a few comments about leverage first. And that is, I don't know how many people on this call have been around since the mid 2000s, 2007, 8, 9, 10, and studied that Great Recession. I had the pleasure of to operating through it. So what I learned, one of the biggest things that happened to investors and to property owners during that recession was badly timed debt maturities. Now, you can't blame them because who would have thought what was going to happen was going to happen. But the people that ran into most trouble had trouble. They just couldn't refinance their debt. Their properties were most likely still cash flowing. Their properties were in great condition, but just so happened that they couldn't refinance their debt when it matured, and they couldn't because the government told the banks, you have to get this real estate off your balance sheet. You just got to get rid of it. I don't care if it's cash flowing. You, Mr. Banker, do not have to renew a loan. So we're telling you, get rid of this stuff, because they were so concerned that it was toxic. And when the regulators came in during that period, they were really making these folks write this stuff down, even though the reality of it was still functioning just fine and cash flowing just fine. So the reason I talk about this is because when you're looking at your deals, I want you to manage your debt maturities very carefully. The only thing that's worrying me right now with this market is there's a lot of people turning to bridge debt. And bridge loans are fine, but you have to be careful, because if you can't get out of that bridge loan on time, they're usually pretty punitive in terms of their interest rates and their penalties and everything else. They'll stay with you, but you're going to pay a hefty price. So be careful with the bridge loans. Just make sure that you model out an extra year or two if something happened that you weren't able to move rents as quickly as you thought, or you weren't able to do something, things didn't happen exactly according to plan. Give you an example. We did a deal in Jacksonville, and the plan was we would start renovating within the next 60 to 90 days. Well, then came a hurricane, right? A hurricane, I don't remember the name, I don't remember which one it was, but the hurricane went through Jacksonville, didn't harm the property at all. It was fine because we weren't on the coast. But what happened was all of our roofers, we were going to put roofs on these buildings, they all had to go take care of people with real emergencies. So we literally had 9-month delay on our capital project, right? So my point is that there's these things you can't necessarily plan for. So make sure that you put yourself in as flexible as possible situation with respect to your debt. I personally like to use the agencies as much as possible. If it's a smaller deal, I love the small balance loan programs. There are some hybrid programs out there that allow you to fix or even float, and you can buy rate caps so that you can you can get longer term loans so that you can ride out any cycle that might come along the way mid term. So just be creative about how you manage your debt, please, and don't over leverage, especially right now, because if we have a slowdown in rents where you're not able to raise rents as much as possible, you don't want to have a situation where you have rising rates, you're up against your interest rate cap if you bought one, and so now your cash flow is going to get skinnier and skinnier. You want to make sure that you're not fully leveraged. I know some bridge loan lenders will take you to 85 and 90%. Just be extremely careful with that. So that's my comment, but with respect to leverage, because most people aren't thinking about this stuff. And I do want you to, because you're kind of gambling if you're going to put a 1 or 2 or even a 3-year bridge on a deal, because you just don't know what's going to happen over the next 2 to 3 years. I certainly don't think the bottom's going to fall out, but I didn't think the pandemic was going to hit either. So I'm not that good at predicting the future, I guess. All right, so now let's talk about cap rates. Question 7, are you good?
No, that's good. That's good.
Okay, good. Let's talk for a minute about cap rates. I don't know, I don't have a feel for how experienced the folks are in this call. So I'm gonna talk for a minute about cap rates, and then I'm going to talk about how I use a terminal cap rate in an example that I'll try to do. And I can try to share my screen to do that if you want. So most people, everybody's heard the term cap rates, and they know that it acts as a multiplier as to how many times cash flow that you're going to buy that building for, that you're going to pay. And that's fine, except for I don't know that a lot of people really know what goes into the mechanics of a cap rate. And it's really not that complicated when you really think about it. So the cap rate, the real definition for cap rate, the most literal definition that I can think of, is it's the weighted average cost of capital for that asset. That's what it is. So when you buy something, you're going to have equity and you're going to have debt, right? Most of that is going to be debt. It's your capital stack, right? I'm sure you've heard that term. So if your debt comes in at 4%, I'm not going to, let's say the debt comes in at 4% and it's 75% of your deal. So the weighted average cost for that debt is going to be 3%. Because you're using it to fund 75% of your deal. Let's pretend like the other 25%, let me try to use a good number here. Let's say you're requiring a 12% return on your equity, right? But it only takes up 25% of your capital stack. 25% of 12 is 3. So in my example, the cap rate for that asset should be 3 from the lender, 3 from your, I'm sorry, 3 from your requirement, and therefore you're able to use a 6 cap to value that property. I don't know if that makes sense. I'm trying to really summarize it because most people don't understand how you get the cap rate. The debt side is going to be always determined by the lender, the market, and the Fed interest rates and all of that. That part's pretty much out of your control. You just have to plan if it's going to go up, and we'll talk about that in a minute. The equity side, though, is very much in your control. And what it really comes down to is what sort of risk, or how do you judge the risk that you're going to take on for that equity? So a good example would be if you're going to go into a tougher neighborhood with a bigger value add project, your equity is going to require a higher rate of return. That means the cap rate is going to be higher when you buy it, right? You're going to pay less because it's a riskier deal for you. Alternatively, right now, what's happened is cap rates are so compressed, the equity that's coming into deals has very low return requirements. In fact, some folks are coming into deals from overseas. They just want a safe place to put their money because it's not safe in their home country, or at least they don't deem it to be. So that when you have a situation where you have equity coming in with almost a 0 return requirement, the debt's the only thing driving the cap rate. And that's why you see debt cap rate compression that you see right now. So in our world, when we model things out, and I'm going to go through an example here, but when we model things out, I want to plan and do some sensitivity analysis on increasing cap rates, right? And increasing interest rates, because as I said in the beginning, I happen to believe that we're in a rising interest rate environment. And I'm pretty sure that if I don't plan for it, I may not be able to add enough value with rent increases to offset the increase in the cap rate. So I really won't make as much money as I thought I was going to do. Does that make sense? Does anybody have questions on cap rate? Let me check my time here. Okay, good. All right, so let me go through. Let me see here if I can do a good job and share my screen. Bear with me here, folks. All right. Let me share my screen. Let's do this one right here. All right, everybody see my screen? All right, so what I'm going to use as an example of a deal, typical deal that we would look at. And admittedly, I'm going to leave out some things that matter, and we'll talk about that in a minute. But I want to use this to illustrate how our value add works in conjunction with leverage. And maybe some of you know this. I don't know if you've gone through the time to actually do the mathematical calculations. We do this with our regional managers, and we push it all the way down to the property managers because we want our managers making good decisions about what they're doing. So let's pretend like we have a 100-unit property in Tampa. The average rent in place is $800 per month. That's legit in the rent roll. Let's say we bought that property for $10 million. Let's assume it was bought at a 5 cap rate. So that means we paid what, $100 a door for the property. The down payment, for my example, is going to be $2.5 million. So that's a 75% loan to value. And let's assume that we need to do some renovations, right? We're going to do a value add business plan. So that's going to take some money. So I'm going to put another $500,000 in equity into the deal for renovations that we're going to do. Let's assume we're going to hold that deal for 3 years. And let's say for this example, that we know we're going to increase rents to $1,000 a month average across the property. Now, remember when I talked about knowing your submarket, and don't be afraid to go to that submarket, drive around, figure out what's going on. When we do these deals, we know that this $1,000 is there because we've done the homework. We've not only done the homework for the comps that we have right now, or the existing comps, but we look up one tier because we want to take the property from where it is now and we want to improve it. So we're going to be competitive with the next tier up. And that's important when you're doing your market study. I didn't mention that before, but I want to, because so many people just pick out the rent comps for the property as the way it sits now, but you really want to understand how it's going to fit into the rent comp set after you're done with your renovations. So we know our $1,000 a month is going to be a good number. So now let's see what happens. And this is why you make crazy money in this business, right? If those, I don't know how many people on this call haven't done a deal yet, but this is what gets people excited. So we said we're going to raise rents $200, all right? It takes us 3 years to do that. Times 100 units, 12 months. That means we increase cash flow by $240,000 a year. Remember what I said about predictability of the cash flow? Now I know there's going to be some expense increases. Let's forget that for now, just for illustrative purposes. So now how much are we going to increase the value? So we generated $240,000 more in income. And we're going to assume for now that we have a stable cap rate. Rates didn't go anywhere over the 3 years. And so we're going to be able to sell it at a 5 cap. That means our profit is going to be $4.8 million. That's crazy money when our investment is $500,000. But we're not done because we actually had to spend $500,000 to make that 4.8. We have to take that away from our 4.8. So that puts us at $4.3 million of profit, true profit. So we put in $500,000 and we generated an additional 4.8, and that's out to 4.3. So now when you look at investor level returns, and probably some folks on this call might be passive investors, some folks might be fund managers or sponsors. So in our example, I'm going to assume that you're a passive investor. So let's say that $4.3 million, which falls to the bottom line when you sell the property, you're only going to get 80% of it as a limited investor, because that sponsor is going to take 20% of the profit. That's a typical 80-20 split. It might be different on the deal that you're doing, but that's not unusual to see that. So then I divide that by the $3 million of equity I put into the deal, divide that by 3 years, I get a 38% annual ROI. Now, in our deals, and in most syndicated deals, there's some sort of preferred return. There doesn't have to be, right? Some syndicators pay out 80-20 from first dollar. It just depends on the deal, depends on the sponsor. We like to do a preferred return so that the investors know that they're at least going to get 7% before there's a split. So in our example, you got 38% from the sale, which is an annual ROI of 38% on the proceeds from the sale, but you're also getting that 7% preferred return while you held the asset. So the total is actually 45% annual return. That's crazy money as far as I'm concerned. Now, a couple of things that I admittedly left off. One was the change in cap rates, which I'm going to illustrate that here. I've also left off a couple other things, like there's probably some sponsor fees in here that I didn't account for. I didn't account for broker commissions and things like that. But you'll see here, if I shave 3 to 5 points off the return, it's still a pretty good return. So now let's take this same example, and this is what we do when we model our deals. We're going to look and say, okay, let's do sensitivity analysis. What happens if rates go up 100 basis points? If that happens, maybe we're at a 6 cap, right? When I say interest rates and the equity requirements go up by the same amount. Run this whole thing through at a 6 cap, it drives the return from 45 down to 38, right? So you can see it's a difference in value creation. We were at 4.3, now we're at 3.5. So that rise in interest rates cost you $800,000, but you've got to model it, because if you don't, and you don't create enough value, you can actually find yourself losing money on these deals if you're not careful. Now, this is my, the world goes crazy sort of example here. Let's say we go to a 7 cap. I can't remember the last time anybody bought a 7 cap in Florida, but for our modeling purposes, we're going to go through this exercise. So running through the example at a 7 cap puts us at a 33% annual return. If I shave another 3 to 5 points off of that, you're still in the high 20s. And certainly I can't find, I'm here to tell you, I can't find a better way, a less risky way to get high 20%, low 30% returns than multifamily real estate. I just can't, right? Everybody needs a place to live, probably not going to change, but even despite that relatively low risk asset, we're still able to get really nice returns. Any questions on my example? Nobody's asleep, are they?
Yeah, if you guys want to put your questions on the chat, go ahead, actually. I will relate if you're feeling shy. No, that's great. It's a great illustration. So.
Good. So let's see, we're on time here. We're about 40 minutes in, right, Stefan?
Yep.
Yep, we're about 40 minutes in, so I do want to leave some time for some Q&A. So let me go back to my remarks here. So that is why, or that is how you create value with real estate. So what that example illustrates is the fact that we're using leverage, right? If you did that with no debt, the returns would look very, very different. That $10 million example, let me do some quick math. On the best case scenario, you'd make 4.3 million on 10.3. So that's rather than on 3 million. It's a completely different return situation. So leverage clearly plays a part in this. Just do yourself a favor and don't get too aggressive with the leverage, and you'll be fine. It'll tamp down your returns a little bit. Don't sweat that, because it's far more important to make sure that you're managing the risk and you're not over leveraged, especially in this environment right now. So that's really what I wanted to talk about. The message here, see, I started this presentation with talking about, everybody, how to make money in this business consistently. And if you apply these principles consistently, here's what will happen when you do. You will get very frustrated because you'll look at deal after deal after deal and they won't make sense. And I'm here to tell you, those are the deals you just shouldn't do, right? Everybody wants to get in on the game. Don't let, what's the fear of missing out? FOMO, right? I think that's a big term that you're hearing now in the investment world. Fear of missing out. Don't let that get you. Walk away from those deals that don't pencil out. Don't allow yourself to, I'll just manage that terminal cap rate and get it down to, 5.5 instead of 6% or 6.5, something like that. Make sure that you're really, really careful with that. So that's the number one message I want to send. I will tell you that we walk away from way more deals than I care to admit. We just don't pursue because they just don't pencil out. And there is somebody who's willing to do something that I'm not, and that's okay. We'll let them do their thing. Am I always going to be right? No, I won't. My approach will probably allow, force me to miss out on some deals. But again, the risk averse nature, I don't remember if Stefan shared with you, but I'm a CPA by background, a commercial lender by background. And because of that, I tend to be conservative and want to make sure, especially when I'm using your money or someone else's money, I'm not interested in losing it. So I want to make sure that I'm conservative. All right, Stefan, what you got?
Makes sense. Yeah, that was great. Thanks, thanks, Ken. Yeah, so let me start with some questions, and you guys can chime in if you like. So I was actually I was curious. So which markets are you guys in Florida? If may ask, like, is it like more of primary markets or secondary markets?
Yeah, I'm in all of them. Anywhere in central and northern Florida. We manage about 2,000 units in the. When I say these areas, I'm talking about the overall area. The Tampa MSA, Orlando MSA, Lakeland, all those parts in between Tampa and Orlando, all the way over to Daytona on the East Coast, and go up Jacksonville. We're about to get into the northwest part of the state because I think there's a lot of opportunities there. The way the investment world has generally approached Florida, Orlando was always the highest priced and the hottest. Well, other than Miami, right? Let's forget about South Florida because I'm not there. So Miami is clearly priced completely differently than the rest of the state. So Orlando, then people would go to Tampa, then people would go to Jacksonville, and now there more and more interest in Daytona. A lot of value add guys going to Daytona and really making the place a lot nicer and investing a lot of money there. Now, I will tell you that some of the deals that we've made the most money on, we just sold a deal in Orange City. I'm sure no one has ever heard of Orange City, unless you live in Central Florida. It's a small tertiary market just northeast of Orlando, about 45 minutes northeast of Orlando, right along I-4. And when you drive through this this little town, you think you're in the sticks. You think, what on earth is going on here, right? And that's what I thought when I saw this property. Except I did a little investigating and I realized it was a big tree lawn about, I don't know, maybe 50 yards off the road. Behind that tree lawn, if you drove back there, the biggest Home Depot I've ever seen in my life, the biggest Super Walmarts, Kohl's, the biggest Hobby Lobby I have ever seen, and the parking lots were absolutely jammed. So these little that's clearly, Orange City is clearly a tertiary market. You got to be careful when you're going through them. That particular city has some zoning rules that they want to preserve the quaint quietness of their community. And they did that by making the big box guys go behind a tree lawn. So when you're driving down that main road, you literally can't see them. So that's a true story. And I almost passed on that deal until I realized, wait a minute, I got to turn right here and see what's going on back there. And I could not believe what I saw. So on that particular deal, it's y'all can see it. It's on one of our YouTube. No, it's not yet. I'm still working on it. It'll be out there soon. The case study, but we did held it for a little over 2 years, and we had a 38% annual return for our investors. So we were thrilled about that. All from some little dinky town called Orange City that prior to seeing this deal, I'd never even heard of. Good question. So don't be afraid of the tertiary markets. In fact, it's probably the best opportunities right now.
Well, yeah, that's amazing. And yes, we have another question on the chat. Do you see repurposing as a possible better value creation? One, hotel or office into affordable multifamily units, etc. Yeah,
good question. We've got we're actually managing a property now for a guy who bought a repurposed hotel. I think you're right. I think bringing real estate to its best and the highest purpose is probably always going to be a way to make money. The thing that I always struggle with the hotels are by design, they have small rooms. And so if the conversion isn't done right and you're not able to make the units big enough, you're really just getting, if you've got 200 units and they're all really small, 500 square foot units, I mean, you're going to have massive turnover because nobody lives in a 500 square foot home for a long time, or at least very few people do. So you're setting yourself up for a lot of operating expenses. So yeah, I absolutely support it. A lot of people are doing, warehouse conversions and all that sort of stuff. Absolutely. Gets a lot more complicated and the risk clearly goes up. I've not done one of those. Being risk averse, I can find apartments and make them so much better that I don't really feel that I need to do that. But certainly is a possibility if you're willing to take on some additional risk.
Okay. Do you see the question, Ken? Or
How do I rehab large multifamily? Are they empty when they're purchased? Okay, really good question. So the dangerous thing about me is asking me a question because then I go on for a while. We look at rehab, and I've been doing this for a really long time, and I've kind of felt like we do it the way we do it because it makes the most sense from a capital preservation standpoint and a cash flow standpoint. So can we buy an empty building and renovate it and fix it up? Yeah, that's not typically what we do. We typically buy an asset that as it sits is a normal running property. It just has massive potential. So we do two things when we renovate. Number one, we start from the outside and work way in. Now I know you probably think, well, of course you would, Ken. Why would you do anything different? I can tell you there are a lot of people who approach this renovation concept the other way around. They try to do it from the inside out. Here's the problem. And the thought process is that people are living in their apartments. They're not living outside their apartments. So they want to make the inside of the apartment really nice because that's what people will see all the time. And there's merit in that argument. The problem is if you're a property manager trying to get someone to that front door so they can open it and show them what an awesome unit is inside, it's really difficult if you haven't renovated the exterior, right? So I know we talk about curb appeal all the time, but curb appeal is more important than anybody thinks because as a leasing agent, as a property manager, if I can't get them to the front door, it doesn't matter how much money you spend on the inside, I can't get them there to even show it to them. So we like outside in, we love building up amenity packages because I think there's a lot of different types of people that live in apartments. Some people, they'll probably never have a home. So they love the fact that we can put resort style amenities in a property. Like you make the pool nice. You have an outdoor kitchen. You have outdoor TV. You have nice pool furniture. Maybe you have an outdoor fire pit. You have a dog park. All the things that most people wouldn't have in one home. They just wouldn't. So now when we tour people, we tour them, we bring them in through the leasing office, into the clubhouse, show them how nice it is with the coffee bar. Then we show them our amenity package. And the story we tell is one where they are actually living in this property. Mom, dad, kids are in the pool, dad and mom, maybe one's working out, the other one's watching the football game in the outdoor TV. Lunchtime comes, they don't have to go back to their apartment. They can cook their food right on the outdoor grill, sit right there at the table and eat. So you can see we paint this picture of a whole family experience. And then by the time we leave the amenity package and we go to the unit, my message to our leasing people is we don't want to screw it up, right? You get them at hello, right? Jerry Maguire movie, you have me at hello. We use that concept to get them connected emotionally to the property, then take them to the unit. The unit has to look good like the rest of the property does, but we don't have to be as worried about making sure that unit is the wow factor because we've already wowed them on the way in. So that's how we approach that. Now, from a cash flow perspective, in markets like Florida, the turnover is pretty significant, right? We don't turn proper units 20% a year. We turn them 40, 45% a year. So that matters because when units turn is when we get our big rent bumps, right? We're going to have regular rent increases of 50 to 75 bucks. I call those nuisance increases. But when we want to move it 300 bucks, we wait till the person leaves. 45% of your property turns every year. You don't need to turn your property any faster than that. So we don't need to encourage people to leave. We just do it as it organically turns. And by doing that, we're able to deliver renovated units to our leasing people at a slower pace rather than dumping 20 or 30 units on them all at one time, because they can rent 2 or 3 units all day long at a time. It's hard to rent 30 units all at one time. So there's a lot of reasons that we do that. It provides extra cash flow. It's really careful with our investors' capital, and it's easier on your team on site because they're able to lease as the things come into their inventory. Good question. Does that help?
So another question, what's your YouTube channel, Ken? If you want to.
Yeah, it's KRI Partners. KRI Partners. I know you didn't ask, but I do have an ebook. If anybody's interested in reading it, I'll tell you. I don't know the makeup of the folks here on this call, but Oh, go ahead, Stefan.
No, go ahead.
Oh, I thought you were saying, I don't, I wrote an ebook and I tried when I wrote it to solve two problems that everybody has in real estate. So the first question that everybody faces, and it doesn't matter who you are, everybody knows it's possible to make a ton of money in this business, right? We know it. Everybody knows it. No, there's very few people that dispute that. The problem and the difficulty that everybody faces is they don't know how they're going to get some of that money, right? How are you going to participate in that? Everybody's here because they want to participate in it somehow. And so I try in the first part of this ebook to take you through that decision-making process, right? I want you to take a real hard look at your life and, you know, what is appropriate. We've actually had physicians who have come to us and want to actually be real estate people. And my response to them is, are you kidding me? You're a physician. I mean, you're making more money than anybody. And it's interesting that you want to jump ship and go to real estate because you're still going to work hard. So when you go through this process, and I take you through this mental decision-making process of what type of real estate you should invest in and how you should do it, where most people end up is that they should be some level of passive investor. They don't want to be real estate operators like we are, because we are running a business. No different. I don't know how many people own businesses on this call, but it's no different than running your business. It just happens to be an apartment complex, and it's a lot of work. And it has the same problems that every other business has. So what I find, most people, when you look at your life in a real, you know, time, kids, family, work-life balance, you put all that together, and most of the time people should be passive, at least starting out in this business. Now, the second half of the book assumes that you want to be passive. And if you do want to be a passive investor, the other thing that you have to wrestle with is, how do you vet guys like me, right? How do you know if the sponsor or the fund manager you're looking at is legit? And so I give you a little bit of insight as to how the business works, and if you're sitting in my chair, what our goals are, what we're trying to accomplish, so that I believe that if I can help you understand the business, you're in a better position to help vet sponsors, because you'll know more about what to look for in certain situations when the terms might not be as investor friendly. So you can get the ebook. It's easy. It's kripartners.com/ebook. If you go there, you just got to give it. The only thing I ask is that you give us your name and email. Then you'll be on our email list. But if you don't want to stay on it, just opt out. No worries. But you can download that ebook, and it'll take you through that process, and hopefully you find it helpful.
Okay, great. Next question on wholesaling. Actually, how would I wholesale a multifamily commercial property? 10 unit.
Say that again. So how? I don't see the question.
How would I wholesale a multifamily commercial property?
How would I wholesale multifamily?
Yeah, for example, 10 units. So smaller multifamily.
Smaller multifamily. I mean, I haven't wholesaled. I guess you could. I have not. In the markets that we're operating in, wholesaling kind of relies on the fact that you're getting a really good buy on the way in, right? And so you're able to flip it and sell it. As you're going to see here, I don't know a whole lot about the wholesale market, because that's not what I do. In our world, we need to create that value. And usually, I mean, I guess you could buy something, hold it for a short period of time, and then flip it. But putting the financing together for multifamily is very different than a single family or even a 1 to 4 family. So it's a lot more expensive to put in place. I mean, I guess you could maybe find a way to assign the contract or something like that, but I'm not very helpful there on the wholesaling, but it's just because I'm not deep in that market.
Right. And next question on inflation. So you mentioned inflation at the beginning of the presentation. What approach would you suggest in an inflationary environment? One can expect the cost of rehab to increase, so maybe it's better to defer the value at one, but also the cap rate would increase due to, one moment, just I lost it. So also the cap rate would increase due to a higher rate on the debt component on the capital stack. So what approach would make sense in the next 1-2 years?
Okay. Good question. So interesting thing, when interest rates go up, think about a potential renter who's looking at living at your property. People need a place to live. They're either going to buy or they're going to rent. one of the interesting things that happens when you rent, or I'm sorry, when interest rates are going up, when interest rates are rising, what also happens? The cost of owning a home goes up, right? So believe it or not, rising interest rates, even though I'm going to model it out for higher cap rates and I'm not going to model out higher, excessive rent increases, what actually happens in a rising interest rate environment is it pulls rental rates up with it, because we're still managing that gap between owning and renting. The gap's not gonna, we're not gonna let that gap get so wide that it doesn't make sense, right? That doesn't make sense. We're gonna continue to make it so that it's, the gap makes sense in terms of how much gap there is. So rising interest rates are going to pull rents up with it. So they don't offset one another. There's so many different factors going in together. I would not recommend that you make that assumption when you model. So one of the reasons I like value add, remember when I started this process, I said, there's the buy and hold, and then there's the value add. We like value add because yes, the cost of our improvements is going up, but it's not so significant that it's going to erode the type of value that I illustrated, right? So let's say instead of 4.3 million in my example, we made 4 million, just because the renovation cost us more because of inflation. You see, there's so much money there that inflation's not going to stop me from renovating. And what it's actually going to do is actually going to allow me to get even higher rents, because the competing product is going to be more expensive, and that would be owning.
Just on that example, a follow-on question, you looked at a 3-year holding period. Is that typical? It seems kind of short.
Yeah, it's 3 to 5. Well, for my example, I tried to use round numbers so that I could do it. It could be 5 years. If it's 5 years, you're going to divide that same number by 5 instead of 3. What I will tell you, there's 2 ways. Now I'm kind of giving you a little bit of what's in the book. There's 2 ways that syndicators or fund managers can approach the sale of an asset. One is, usually when you meet somebody, everybody's always happy to disclose how many units do you manage? How many units do you own? I've got 1,000 doors. I've got 3,000 doors, right? It's so, and I get it. I fall into the same trap sometimes too, because it sort of is a benchmark, right? When we do what we do in the value add business, my goal is not to increase my unit count. My goal is to timely exit that asset. So the Orange City deal, we exited after 2 years and a month. I pro forma'd 5 years, and I pro forma'd my minimum equity annual ROI was, I think on that deal was like 16 or 17% over the whole 5-year period. So I gave myself a lot of room, right? I call that under promising and over delivering. I was able to get there and then some, right? Obviously I beat it, but I was able to do it in 2 years and a month. Now, why didn't I hold 3 more years? Because in order to take that property to the next level, I would have needed a lot more capital, right? Well, if you're in the syndication business, the last thing your partners want to hear is a capital call because you want to do more renovations. That just never goes well. So you implement the business plan that you thought you were going to implement, you spend the amount of capital, you get it to as far as you can take it, leave some for the next guy, and then you sell it. So 3 years in my example is not ridiculous. The property we just sold in Jacksonville was 3 years, 9 months. Trying to think, the one before that is 2.5 years. It in a growth market like Florida, you're going to make a lot of money in 5 years. No question about that. So it could be longer. I like the 3 to 5 hold because the other reason I do this is I don't want to outlive my improvements. Think about your personal home. If you renovate your kitchen, right, what's going to happen in 7 to 10 years? You're going to do it again because it just gets tired. And so I don't want that to happen in my world with investor capital, because when we renovate, we spend $500,000, $750,000. I don't want to do that twice because your returns will really be bad then. So that's why we plan those short hold period. And admittedly, I told you my example had some flaws, and that you could take that out to 4 years, just divide by 4. Good question.
Do you have a question? Actually, Jagdish, no?
No, I just said thank you.
Okay.
Oh, no, thank you.
So good. Yeah, next question. Any suggestions on how to find the right and good deals? My company focuses on the New York area. Cap rate is too low here on the open market.
Yeah, that's when cap rates so it depends on your goal. If your investment goal is a long-term high buy and hold, and you're not going to be worried about cash flow for the next 2 to 3 or 4 years, then you can buy in at those like cap rates. Just make sure you can make your debt service. Make sure your debt service coverage is 120 or higher, because you don't want to be in default on your loans. But if you're trying to do a value add, that's the situation where you need to really understand your market. Now, this is going to be a little bit long-winded, but some of the best deals I have seen people do, I've seen them buy at a 2 cap in a growth market. Now, let me explain, right? Nobody ever, you would say, why on earth would you ever do that? They did it because when you're in a growth market like Florida, see, New York, I don't know that you would qualify as quite the growth market, but when you're in a growth market and you know you're going to add a ton of value, you analyze that deal actually the exact opposite the way you do normally. So you look at the market and you say, you know what, this property is here. Rents are low. They're too low. They shouldn't be this low. The expenses probably inflated because it's poorly run. And when you have low rents and inflated expenses, you're going to have, by definition, a low cap rate, or in a good aggressive market, people are going to be willing to pay a low cap rate, because the upside, which people thoroughly investigate and they know exactly where those rents are going to go. They know where they can get that, where they can take them. They then look at the renovation cost and what needs to be there. This is called experience now that we're drawing on to make this happen. Then we bake in how much return do we want, and then that takes us to our price that we're willing to pay. That is completely the opposite of an analysis that most people are used to doing, and that is look at in-place rents, look at in-place expenses, move taxes as if it's going to market value, and then apply your cap rate and don't pay less than that, right? That would be the traditional correct way to analyze a deal. But if you know what you're doing and you're comfortable with where you can take that property, you can, and we have done this in the past, look at the whole deal backwards and paid what seems to be a ridiculous amount in the beginning, but we made so much money because we knew the upside was there. Because as soon as we took it over, it didn't look like a 2 cap anymore, right? It just didn't. So
yeah, that's a great point. That's a great point. It's just sort of like some interest rate, like cash flow risk at the entry, but it's actually a bigger value add potential there. So
yeah, it takes some, I won't lie to you, it takes some guts to do that. You really need to understand your market, because you're taking a lot of risk, and you have to have experience. Lenders are going to hold the line on what they're going to advance. The lenders are going to do it the traditional way. They're not going to do what you're doing unless you go to a bridge loan, or unless you go to hard money lending or something like that. That'll advance more. Now, there are also some loans in place where you can get, and a lot of people do this, they'll look at your in place, go to your 120 debt service coverage, and then they'll give you an advance on the improvements as you're able to turn the rent roll and increase rent. So there are programs out there where the lender will participate in helping you fund those CapEx. But again, the lenders are kind of the opposite there. That's why I wouldn't recommend it on your first deal, that's for sure, because you really need to understand the upside, because if you miss that, you're gonna be sorry. You're gonna be in a situation where you overpaid.
Okay, thanks, Ken. Yeah, the next question. So I would like to start investing in real estate. I have 70,000 saved up and 20,000 car debt. Do you recommend to pay off the car and then buy to decrease the expenses? What type of property would you buy if you were me?
Yeah, so you said you had a $20,000 car that you have a loan on. You have 70,000 in the bank. Your car loan is probably relatively low interest rate. So, there's a lot more of your personal things that I don't know. So what kind of real estate would I buy if I were you? Well, it's going to depend on so many things. What you're doing in your day job, how much time you have. This sounds a lot like my very first deal that I did back in 1997. It was a 28 unit apartment complex. It was my first deal. I did it with my in-laws. They put in half the equity. I borrowed my half of the equity on my home equity line. And
I'm sorry to interrupt. Just the person added, he's actually from Miami, just FYI. It's an additional piece of information.
Okay. He's from Miami. Okay. But yeah, so he's probably not going to buy a 28 suite apartment building in Miami. Here's my point, right? The point is that usually when people start off in the business, they, a lot of guys like do what I did. And that is they went in, I borrowed the money for my part of the down payment. And after I figured out the business with my own money, my in-laws, it's basically my money at the time, sort of grew up in the business. So I did that. Now, what would I do with would I pay off the car? The question I think you're asking is, would I pay off the car and then have only 50,000 left? It's going to depend on your ability to use interest rates against, can you earn more with that $20,000 than you're paying in interest? That's the way you should look at it. I will tell you that I'm a fan of trying to eliminate as much of your personal debt as you can. However, if you make the right investments in real estate, as you can see, you can make ridiculous amounts of money and you can get on your path to financial freedom a lot quicker. You might want to read if you've heard of Rich Dad, Poor Dad. That is exactly what I think he would tell you to do, is to get out of the bad debt and start investing in assets like real estate. And if it means you buy a single family house and rent it out in Miami, then you do that, or a condo and do that with $70,000. Or you can get together with 3 or 4 people on this call and do it together. That way you're able to not only learn together, but you're able to buy something that's bigger. So there's so many different routes that you can go. And it's hard for me to give you a real honest, definitive answer, because there's so much about your life I don't know.
And so would you recommend to some to start with single family, then go into multifamily, or just go into multifamily?
Yeah, I'm a fan of starting in multifamily, and here's why. When I went through that process of trying to figure it out, I looked at single families.
Sorry, just as an additional, so the same person asking. So, and if you do recommend multifamily, do you think starting in smaller multifamily, duplexes, triplexes, or is it more units okay to start with?
Yeah, so I picked a 28 unit apartment building because at the time I was working for Deloitte, which is one of the big accounting firms. And I don't know how much you know about accountants, but we work really hard when you work for those firms. So you spend a lot of time. That meant I needed to have a staff on site that could show the apartments, that I had enough money to pay maintenance guys. So that's why I picked a larger one, because it just made sense, and I could have somebody on site and I could treat it like a business. I remember thinking very vividly that I wanted it so that I could run it like a business. It's hard when you have a single, a double. When something breaks, you are going to be there on the weekend doing it yourself. You will, for 2 reasons. One, you're going to make that decision. Do I go pay the plumber or do I do it myself? Well, the plumbers are expensive. And then 2, you're going to look at how much cash you have left over, and there's just not going to be that much with a single or a double. That's why I'm a fan of starting out a multifamily, because I can run it like a business, something I understand a lot better.
And the next question, do you feel work from home, smart home and home office features are offering a good return on investment, or still higher to focus on appearance and basic living amenities?
You're talking about renovating inside a unit? Is that what you're referring to?
Well, I'm not 100% certain. More like features, more like office feature, home office features. If they
in an apartment?
Adding to a property.
Yeah, so anything you can do that will make somebody emotionally connect with your property, I would advocate. So a lot of people now are putting USB ports in their apartments. I'm not a fan of that, because I think USB, the normal, I'm not a technician, but the normal USB that everybody's used to, they're on their way out, I think. So I don't know that I would necessarily do that, but home thermostats, we like those. We like those for a lot of reasons, because in Florida, you need to have the air conditioner on all the time, no matter what, or you get mold in an apartment. So I would do those things. Tenants are always going to have access to Wi-Fi and cable, internet. So I don't know. I'm not a fan of providing that for them, because I don't want to take the technology risk. But, I would sell a 2-bedroom or a 1-bedroom with a really small den. I would sell that all day long as a work at home environment. I prefer personally 2 bedrooms over 1 bedrooms. I prefer my unit mix to have much heavier 2 bedrooms because I can sell that 1 bedroom as either a bedroom or a den, a place to work. So remember I said I don't like this a property with 200, 500 square foot units in it. That's one of the reasons, because there's not much you can do in 500 square feet except put a bed and a small kitchen. You can't work at home in that environment. It's just too hard. Good question.
Yep. And so next question again on interest rates. Do you think interest rates or mortgage rates stay historically low in the next 5 years? Federal Reserve announced they may raise interest rates in 2023. But when you look at the long-term history of interest rates from 1971, it looks like going down. That is correct. I don't know if 30-year mortgage rate can go up to like 4% in the
Yeah,
future.
so I think what you're asking me is to try to make a longer-term interest rate projection. You want my opinion. And I'll caveat it with it. It's just my opinion. Here's the interesting thing that we find ourselves in right now, the environment. The inflation that everybody is talking about, I want you to think about what happened with the pandemic. When we shut down the economy, we literally turned the lights off. We walked over, shut the switch off, everybody went home. I mean, that's remarkable with the way that happened. Now we're coming out of the pandemic. The demand side of the equation, flip the light switch on. We did, right? Just look at TSA. They screened 2.3 million people yesterday, which is crazy numbers, right? Here's the problem. You can't flip the light switch on the supply side. You can't do it. It takes time. So the inflation that we're seeing, I believe most of these inflation numbers are going to be temporary because it's just like a giant ship, right? A freighter takes a while to get up to speed. When it does, you're doing fine. We flip the light switch on. We're waiting for that supply side to catch up. That's what's happening. And I'm sort of proven right, I think, when you look at the prices of lumber, they've already come down considerably because the supply chain is backfilling. Same thing with the airlines, the American problem that they're having right now with canceling all these flights. It's only because they need ramp up time to get the pilots trained and get them back into the cockpits. They can't flip the switch, right? I can show up and buy the ticket immediately. You can't bring a pilot out of retirement and throw them in the airplane. It requires too much training. So I believe this inflation is going to be relatively temporary. That's what I think. Same thing with labor, right? I think it's going to be temporary. So the longer term, I think we're fine. I'm not too worried about it. What I'm carefully monitoring right now is how the Fed responds to the temporary, what I consider to be temporary supply side inflation that's just waiting for it to catch up to the demand. And a month ago, I was concerned because I didn't think that they were going to see it the same way I was. And I was thrilled to hear Powell say, I think he testified today before Congress. I didn't hear any of it, but I know his initial remarks sort of implied that they believe this inflation is transitory, which is what I think it is. So that means that they're not going to respond in the wrong way to this, right? Raising interest rates to control transitory inflation doesn't make sense because you're addressing a cause it's not relevant here. So they're going to let it catch up. That's why I think they pushed it out to end of 22 or 23 because they want to see what happens over the long run. Do I think rates are really going to skyrocket? I don't think so. I just don't. I just don't think the federal government will allow that to happen. And so the Fed will keep buying our treasuries. The biggest risk that we have is the debt that we have as a U.S., as a country. We have massive amounts of debt that we need to refinance on a regular basis. That is the biggest risk in my mind that's going to drive long-term rates up. But the Federal Reserve buys those notes so that the rates don't get ticked up. I don't think they're going to stop doing that if they see rates climbing to the point where it starts to stifle demand. So the short answer to your question is, I think we're going to have rates go up some, not enough that's going to change the world. And I think they're going to be relatively moderate is what I think. We're not going to go into any hyperinflationary time. At least I don't think so.
Yeah, that was a great comment, Ken, on like on transitory inflation and kind of like short-term supply demand in bonds. I think, yeah, that's a great point there. So do you guys have other questions? We're already over time.
Yeah, sorry.
Maybe we can take one last question.
Do you see
No?
any? Okay. Well, Stefan, thanks for
No,
having
okay,
me. I
sure.
really appreciate it.
Thank you, Ken. That was great. That was lots of great value to everyone.
Remember, if you want to get the ebook, just go to kripartners.com/ebook. If I could do one last shameless plug, I'd appreciate you letting me do that. But
No, absolutely.
anybody has
We
questions, they
actually-
want to talk privately, you can reach me right through our website at kripartners.com. I'd love to have any conversation with you. And anything we can do for you in Central and Northern Florida, just let me know.
Thank you, Ken.
You bet.
Thank you so much.
You bet.
Bye-bye. Bye, everyone. Thanks for joining.